and welcome to Indianomics. The big event for the business community next week is the credit policy. Considering that last time the governor gave a double cut, a 50 basis cut, and said he is front-loading the rate cuts, is this policy a non-event? On the other hand, can he sound less generous this time, given the load of the 7th Pay Commission? Is his talk more important than his walk? All those questions to three important RBI watchers: Chetan Ahya, Managing Director and Chief Economist, Morgan Stanley; Prasanna, Chief Economist, ICICI Securities PD; and the big banker, Kannan of State Bank of India. But before I get to my guests, here is a brief poll that my colleague Ritu Singh prepared after speaking to a bunch of economists and bond dealers.
Raghuram Rajan's surprisingly generous rate cut in the September policy has weakened the prospects of another such gift anytime soon. All the top economists and treasury heads polled by CNBC TV 18 chimed in a unanimous pause by the governor as far as their expectations from the December policy is concerned. And it comes as little surprise after Rajan's warning last quarter of RBI front-loading the cut.
The coming Pay Commission report could add substantial fiscal stimulus to domestic demand, but the government has reaffirmed its desire to respect its fiscal targets and improve the quality of its spending. Under these circumstances, the Reserve Bank intends to be accommodative to the extent possible. Therefore, the Reserve Bank has front-loaded policy action by a reduction in the policy rate by 50 basis points.
According to CNBC TV 18's poll, the key repo, cash reserve ratio and statutory liquidity ratio rates will remain unchanged in this policy. However, this will not be the end of the rate cut cycle. An overwhelming 90% of the respondents to CNBC TV 18's poll say RBI will remain in an accommodative stance. While 10% expect no rate cuts from now till the end of next year, 30% expect a 25 basis rate cut and 50% expect a 50 basis point cut. The governor's tone will be as keenly watched as the policy statement itself, and 55% expected to remain more or less neutral like in the September policy. But owing to the risks from the eventual Fed liftoff and the possibility of the government missing the fiscal deficit target with the hefty 7th Pay Commission recommendations, 45% expect the tone to be more on the hawkish side. The retail inflation target for January 2016 is expected to be maintained at 5.8% by a majority of the respondents. All respondents also believe the GDP forecast for FY16 will be maintained at 7.4%. This has been an eventful year for the domestic markets, with a 125 basis point reduction in benchmark rates by Raghuram Rajan. But going by CNBC TV 18's poll, the end to the year is expected to be rather quiet. In Mumbai, Ritu Singh.
Well, so Ritu's conclusion is no cuts this time. That's the unanimous answer. But some chance of the Reserve Bank upping its inflation trajectory, probably because of the 7th Pay Commission. Well, that's not good news for the coming year. But let me get to my experts now. Once again, let me introduce Chetan Ahya, Managing Director, Chief Economist, Morgan Stanley; Prasanna, Chief Economist, ICICI Securities PD; and Kannan, Managing Director, State Bank of India. Gentlemen, thank you very much for joining me. First up, Prasanna, the 7th Pay Commission, will that be the big thing that you will watch out for in the forthcoming policy? The fact that it might alter the Reserve Bank's dovishness, which was very prominent in the previous policy.
Yeah, definitely it's an important development, but we have to remember that it was not completely unexpected, right? Pay Commission had been set up quite some time back, and the report is expected any time at the end of this calendar year. And if you look back at the last policy itself, RBI had mentioned it actually explicitly in the statement, and also said that they expect the government to stick to the fiscal roadmap. So, and I would assume that RBI had factored in some of this impact in terms of higher pay and therefore higher spending, higher consumption, and some growth boost into their calculations when they projected inflation a year ahead. Maybe you can argue that some of the numbers might be different from what one would have assumed earlier. So to that extent, there could be some minor adjustments. But I don't think this would call for a complete change in RBI's language or the projections from the previous policy to this policy.
No, let me break it down. What is your own expectation in terms of the load on the deficit itself? What percentage? Is it 0.7% of the GDP that it will add in terms of expenses? And more importantly, the house rent component, which goes up by 138%. What will that do to the Reserve Bank's CPI trajectory for FY17?
Yeah, so it is 0.7%. Actually, if you add OROP, it can actually go up to 0.85% also. But then you have to remember that, I mean, this is not just a standalone thing, right? I mean, actually, the economy is also growing, so revenues will also grow. And one would assume that there is a service tax hike again, which is going to be in the offing, because as we go towards GST, service tax has to keep going up. So if you put all together an as-is-where-is basis, what we estimate is the deficit can go up to 3.9%. Or in other words, government has to still find 0.4% extra compared to this year in terms of additional revenues or some savings and spending to come back to 3.5%, which is part of their roadmap. So essentially 0.4% is what we should focus on. And as far as the CPI impact, the housing impact which you mentioned, it's not 138%. I think there is an increase in coverage of HRA also. So if you kind of strip that out, it's actually 109%. But what we have found out is that if the government-owned housing or the housing occupied by government employees in the CPI housing basket, I think it amounts to only around 3% or slightly less than 3%. So our own estimate is, actually initially we estimated 50 basis points, but now we have kind of drilled it down and we think it's only a 30 basis point increment in the overall inflation because of this HRA.
Well, let me get Chetan's lowdown on next year's both fiscal deficit and inflation trajectory. Chetan, what would you make both GST and more importantly 7th Pay Commission?
So we are projecting fiscal deficit for next year for the central government, Latha, at 3.9%. The reason why we are not showing much slippage because of 7th Pay Commission is we think that this financial year itself the government will be able to show for March 16 a lower deficit than what they were projecting. The 12-month trailing number is right now at 3.4%. So they are doing pretty well, and they've just done additional hike in excise for petrol and diesel. So they have got protected and created enough buffers on fiscal deficit. So we don't think it will be a big slippage from what we had expected earlier for March 17, only because March 16 is going to be much better than what we had projected earlier. And just Latha, to add to the point on inflationary impact of wages, that's what really is important for RBI when we're mentioning this in the context of RBI's action. You can weigh it in two contexts. One is whether this will create too much demand and therefore inflationary pressures. Well, right now the economy is running at a very low aggregate demand, so we don't think that will be a problem. And from the cost side, it will be a problem, if it is seen to be in terms of weighing on wage expectations of even just the public sector. They know this is one-off. From next year onwards, wages to GDP will begin to normalize for central government employees. And more importantly, we don't think it's going to have a pass-through into private sector wages, because private corporate sector are not making money, and they're not going to be responding to this wage pressures from the public sector, which is also one-off. So no cost side pressure, no big demand side pressure. We don't think this is really a big issue as far as the inflation outlook is concerned.
So you will stick with, you expect the Reserve Bank to stick with its inflation trajectory. It forecast between 6 and 5.5%, I think, up until mid-calendar FY16, and then going down between 5 and 5.5%, and an inflation of 4.8% for the first quarter of 2017, that is Jan 2017. You think that will be pretty much what they will stick with? Of course, this was in the monetary policy report. It was not in their policy statement, the FY17 trajectory. But will they stick with it, or will they indicate that Jan 2017 could look higher?
Ideally, they should stick with it, because I think, Latha, it seems to have got the buffers of maybe the pay commission effect already, or whatever the other concerns the RBI has from potentially oil prices going up. Just to contrast that forecast, we are not expecting inflation to really go much above 5. So for the bulk of that period, the forecast range that you mentioned, we are sticking on with around 4.75 to 5% range for inflation. And our confidence comes from the fact that all the sources of inflation are supportive. The only concern we have is in food prices. And food prices, as you can see, it's only in tur dal and tomato. It's not transmitting generalized to other food items, so that's comforting. And so therefore, we are still sticking on to our range-bound forecast of around 5%.
Okay, I'm raising the entire fiscal and inflation argument only to check whether the governor will continue with that other big Santa Claus gift he gave us last time, when he said that I am still in accommodation mode. Prasanna, both of you are expecting that the fiscal deficit will not be 3.5% in FY17, but 3.9%. When there is going to be fiscal looseness, can the governor persist with accommodation in this policy as well?
Yeah, so just to clarify, what we said is it can go up to 3.9%, but what we expect is government will try and take steps, whether in terms of additional resources or trying to trim the expenditure. So they will try and bring it as close to 3.5%, at least in February when they present the budget. I think that will be their effort. So I think 3.9 is really the upper end of where it could go. So I think at this point of time, I think RBI will also kind of point to government's fiscal roadmap and whatever public assertions by the government. Right, so that is all they have to go by. So clearly, it's not logical for the central bank to assume that the government will exceed the fiscal deficit. I think so. They will still point to the fact that the government is expected to stick to 3.5%, and therefore I expect them to retain that accommodative word. And remember, I think the accommodative word doesn't actually mean or lead to an immediate action in the near term. I think that is something which RBI had also clarified in the last statement. Right, so they are still waiting for more transmission and definitely, I don't think prior to budget, I think RBI will have any bias towards any rate action, even though they might retain the word accommodative.
Okay, so Chetan, you think they will retain the word accommodation?
We are thinking that they'll maintain the word accommodation in the monetary policy, and we think they will cut policy rates by 25 basis points in February when they meet.
Okay, they meet in February before the budget. You expect that rate cut even before the budget?
Yeah, because I think they would get the comfort of inflation maintaining at around 5, because as you know that their trajectory of inflation is showing an uptick. And I don't think that, budget per se, they will know something new. The fact that they have actually been maintaining fiscal deficit quite better for this financial year itself. So unlike the last time when they wanted to know what the new government's policies are, now it's all very clear what their policies are, and actual trailing data is probably going to give them the comfort that these guys are managing fiscal deficit quite well.
Well, I have still a couple of questions for both of you on what the governor's accommodative stance will mean to the banking sector and the economy, and we will have SBI's VG Kannan also on that. We have to take a break. We are back with all our three guests.